Alright, let's jump right into this explainer of the Global Macro Week Ahead report. Looking at August 17th through the 21st, 2026, we are staring down an absolute mountain of global economic data, and honestly a completely fractured economic landscape. That unified business cycle we've gotten so used to in recent years, well, it's effectively over. Let's dive in. I mean, just look at the schedule from the report. The sheer volume of data dropping every single day is pretty overwhelming. Monday kicks us off with the Bank of Japan and China. Tuesday brings Australia and UK jobs. Wednesday is massive with US CPI and FOMC minutes, followed by European bank decisions on Thursday, and we finish the week with crucial US retail sales on Friday. We really need to organize this. So rather than getting whiplash bouncing day to day, here is our agenda. 1. Asia Pacific, the hawkish shift. 2. North America, a waiting game. 3. Europe and UK, balancing acts. And 4. Key takeaways for the week. Starting off with Section 1, Asia Pacific, and the hawkish shift. Kicking things off in the East, it's actually fascinating to see the divide right out of the gate. On one hand, you've got the Bank of Japan and the Reserve Bank of Australia sounding the alarm on inflation and really leaning hawkish. But then you look at the People's Bank of China, and they are dealing with a totally different reality. Facing weak domestic demand, Beijing is heavily favoring targeted liquidity over broad easing, which means they're likely keeping their prime rate locked right at 3%. Now, what is truly wild here is just how deeply entrenched Australia's higher for longer narrative has actually become. The RBA kept their rate at 4.35%, but Governor Bullock basically came out and said inflation won't hit their target until late 2027. And get this, they didn't even discuss a rate cut at this recent meeting. They literally only debated whether to hold or hike. Meanwhile, over in Japan, market bets are now pricing in a 62% chance, yes, 62%, of a rate hike as soon as September. Why the sudden urgency? Well, Japanese policymakers are sweating over a weak yen and surging energy costs, which are being heavily fueled by this massive global demand for AI infrastructure. Delaying a hike is just getting way too costly for them. Moving right along to Section 2, North America, and a waiting game. Alright, turning to the US, with upcoming consumer price index data and the FOMC minutes hitting this week, the multi-trillion-dollar question is simple. Does the Fed hold or do they hike? Remember, 3 regional presidents actually dissented recently, voting for a hike specifically because of this AI boom. And with the Fed giving absolutely zero forward guidance right now, every single meeting is a live wire. But let's look at the actual numbers, because the economic engine is definitely sputtering a bit here. Headline inflation cooled nicely to 3.4%, and core is down to 2.5%. The real red flag, though, is consumer spending. Retail sales fell by 0.6%, and the absolutely crucial control group, which is the specific retail data that feeds directly into the US GDP calculation, dropped by 0.4%. That is a real loss of momentum. And because of that weak spending data, markets are now pricing in a massive 67% probability of a September Fed hold. Just weeks ago, this was a total coin toss. So if you're watching your portfolio, the market is completely looking past those hawkish dissenters right now and betting heavily that the Fed is going to stay patient. Looking up north, the Bank of Canada is walking its own really delicate tightrope. They've rustled inflation down to a beautiful 2.8%, which is great. But they are terrified of downside growth risks stemming from US trade uncertainty. If they cut rates now, they risk overstimulating. So for the time being, their hands are basically tied. Next up is Section 3, Europe and the UK, balancing acts. So the UK is bracing for an absolute avalanche of data this week, sending completely mixed signals to the Bank of England. Jobs are steady, but inflation is proving stubbornly sticky, largely thanks to adjustments in the UK's off-term energy price cap. June's growth breakdown was notably weak despite a strong Q2, and retail sales have literally been melted by a summer heatwave, which just proves that sometimes macroeconomics really is just about the weather. Shifting up to the Nordics, both Norway's Norges Bank and Sweden's Riksbank are holding steady, but they're staring down some serious geopolitical and inflation risks. Norway held at 4.25%, explicitly stating inflation is still too high, keeping a September hike on the table. Meanwhile, Sweden is expected to hold at 1.75%, but they've made it crystal clear that the risks are shifting upward. Wrapping up the European tour in the Eurozone, traders are going to be laser-focused on the latest flash PMIs. These are essentially health checks for different sectors, where any number over 50 means growth. Manufacturing is edging up slightly to 52.0, but services are softening at 51.6. The real story, though, will be the underlying commentary hiding inside these reports, as economic powerhouses like Germany and France continue to diverge. Finally, Section 4, Key Takeaways for the Week Ahead. Okay, distilling everything we've covered from this Week Ahead report, it's clear the once unified global economic cycle is fracturing into three very distinct narratives. Asia-Pacific is battling persistent inflation risks, North America is pretty much paralyzed, waiting on consumer data, and Europe is walking a precarious tightrope between sluggish growth and sticky prices. So as the data rolls in this week, I want to leave you with this question. Which region's strategy will ultimately win out in this ongoing fight against inflation? Keep a very close eye on those US retail sales, because whichever way the North American consumer goes, the rest of this divided world may eventually have to follow. Thanks for joining me for this explainer, and stay focused out there.